Welcome to Resource PNG. Now, in this program, Resource PNG is fortunate enough to speak with Dr. Fereidun Fesharaki, the founder and chairman of Facts Global Energy. Now, FGE is a leading consulting group focusing on the oil and gas markets. Now, Dr. Fesharaki's work is well recognized worldwide for pioneering oil and gas market analysis and studies of the Asia-Pacific and Middle Eastern markets since the early 1980s. Now, Dr. Fesharaki speaks with Brian Gomez.
Dr. Fesharaki, welcome to Papua New Guinea. I know you've been a regular visitor over many years and you are quite an expert on the PNG oil and gas scene. I thought I might start off by asking you a little bit about the global scene as you see it. What's been interesting is last year when the prices suddenly fell, a lot of companies and countries seem to have been taken unaware. But in fact, the situation had been building up for some years because of rising US oil shale production. And it came to a head when OPEC decided that they were going to not curtail their production, so prices took a tumble. How do you read the situation at that time?
You know, a lot of people have pinned their hopes on a so-called new normal, which is $100, $110 a barrel. That new normal was a fake normal. It wasn't really a proper price. It was managed by the Saudis, and they reduced and increased their production to keep the prices at those levels. So it was an unusual period because everybody liked the higher prices. The sellers of oil liked it. The consumers liked it too. Although the price was high, they could develop alternative energy sources. They could develop energy efficiency, but also could curtail consumption. So it was an environment that everybody liked, but it was an unsustainable environment. The higher prices kept a lot of new oil coming in, and even the oil producers at $80 a barrel would come in because they would make $20 to $100. So it created a competition that now it's very hard to get out, force out of the market. And the Saudis had no choice but to abandon the policy and start on a market share policy, let the prices go down to decide who has the priority. In the Middle East, the cost of oil production is still $5 a barrel. So basically, they should prevail. But at current prices, still a lot of the producers in the US or elsewhere remain in the market. If you want to push everybody out, you need to push the prices below $30 a barrel. And that would be very tough for many people politically to do.
Yeah, with the OPEC and the Saudis, do you think in retrospect what they did, they had no choice doing?
I think they had no choice doing it. The Saudis could have kept the price at $100 another 4 or 5 years by cutting their own production. But at the end, the problems don't go away. You really need to have a readjustment where a lot of high-cost producers do not produce and the low-cost producers produce. If you have a situation that a low-cost producer had to shut in so high-cost producer produces the oil, something is really wrong with that kind of picture. And I think we are now in the transition to a rebalancing. We don't know exactly where the rebalancing will end up, but we are now in the middle of this transition.
One of the sort of awkward outcomes of all this is that much of the oil reserves that exist are in the Middle East. And in fact, I think many of the Middle East countries don't really know the extent of their reserves because there hasn't been much modern exploration done in these places. So how do you read that situation? Because in a way, you know, they look like they're losing on all fronts at the moment.
I think that's a good way to put it, that actually, not only in the Middle East guys that don't do exploration, but they don't even know how much the reserves are. In the Middle East, if you want to know what the reserves are, you have to bring an international audit firm. An international audit firm will tell you what the reserve is, but they also have to tell their own governments. So if you want to keep secrets about your reserves, the best thing is not to know it yourself. So whatever the countries in the Middle East say, that's what the numbers which are listed. There is no firm numbers in the Middle East. We know there is a lot, but we don't know how much. So many of these countries, they enjoy the $100 oil. As the prices fell, they found out that actually they're having a tough time, and also that the only way for them to get their market share back is to keep the prices low, which nobody likes. So very difficult environment for them. But at the end of the day, they will prevail if they're able to stand the pain long enough to force the other people out of the business.
Do you think there was a certain amount of miscalculation on their part? Because it seems like when OPEC decided to try and keep its market share, there seemed to be a view that once oil prices fell, say, below $70 or $60 a barrel, that they would badly constrain and hurt the US shale industry. But that it's not happening.
That's absolutely correct. Actually, none of us knew. I think even the Americans themselves didn't know. So there was a misconception that by $70 everything gets shut down and they can begin to be the rulers again in the business. But what was underestimated was the resilience of this smaller scale producer. Actually, if the big oil companies were the Saudis may be right, but the smaller scale producers, they keep innovating. In the past 6 months alone, every month the cost has come down 5%. So today at $50 a barrel, most US producers still get up to 20% rate of return. The costs are still going down. We don't know where the floor is, but maybe by the end of next year at $40 a barrel, they could still make a decent rate of return. So what they didn't know, the Saudis, was the resilience and the ability to reduce costs. And yes, they did miscalculate, but even if they knew this, they still had no choice. They had to rearrange the global system. The old way wouldn't work.
You're watching Resource PNG. Mr. Gomez continues his discussion with Dr. Fereidun Fesharaki after these messages. You're watching Resource PNG. Now, Mr. Gomez continues his discussion with Dr. Fereidun Fesharaki.
What's also very interesting is that in the US, even though the number of oil rigs operating has fallen quite dramatically, production seems to be holding up. And there's some reports recently that some of the oil shale production can be can have a break-even price of as low as $22 a barrel. So what do you read into this development?
I think that looking at the rigs as an indicator of production is the wrong way to do it. Because remember, I was telling you that some of these projects, even at $80, $90 came in, a lot of bad projects started. So a lot of the bad projects go out. And also rig efficiency continues to increase. In so many places, you lose less rigs, but you have more productivity. So looking at rigs as a number is not enough. It gives you a directional indication. So for example, this year, on a total year, we're looking at a 600,000 barrels per day increase in the US production compared to the year before. But if you look at the last quarter of this year, compared to last quarter of last year, we're looking at a 800,000 barrels per day decline. So if we look at the whole of next year would be 400,000 barrels per day less than this year. So no growth, but some decline. So these things do have an impact. But the impact is not a devastating impact to suddenly bring a collapse, which is what Saudis had expected. So it is going to be more moderate, and only the future demand will go to OPEC. But the existing production is likely to hang on for many years.
Okay. 4 or 5 years ago, there was a lot of talk about peak oil. The idea that oil production would rise to a peak and then start to decline. And that partly supported the idea that oil was going to be $100 a barrel, maybe forever. But all that has changed now. So how do you read the changes?
The peak oil production, peak oil story was based on decline rates, that a lot of oil would decline, and there's no new areas to be discovered. So we have to reach a maximum, and then the volumes fall, and the prices will have to go up. This is fundamentally still not wrong, but because of additional technology, you can get a lot more out of the ground than you could before. So rather than have a decline rate, many people are stabilizing production. Places like North Sea, production has fallen, but not collapsed yet. In the Middle East, decline rates have had no impact. The production is still flat because of the application of new technology. So we are able to stretch things much longer and make it, give it a longer life. That is, I think, what's happened. But unconventional oil was not in our calculation. Unconventional production, which in the US now 5 million barrels per day, bigger than the total production of oil in Iraq or in Iran, all in 4 years.
Yeah.
This was not on the cards. And that is really has come and changed the picture very dramatically.
So with these dramatic changes, what do you think are some of the implications for Papua New Guinea's oil and gas sector?
Well, you know, in Papua New Guinea, like many other places, there's always a dream to go back to the $100. So we have to abandon the dream. That dream was a fake dream. The prices will not go to that level, but somewhere in the range of $50, $60, $70, $80, that range, we have to be able to manage. Definitely means lower revenues for LNG. Some very expensive projects are harder to commission. I think still Papua New Guinea has specific advantages. But it's not going to be a sort of easy path. It is going to be a struggle. And in that struggle, participation of the private sector and the government becomes necessary, because in a time of too much supply, you need to have something special to sell. And something special to sell is your costing, but also the intervention of the government as a marketing tool, which during the time of PNG LNG was not necessary. It just sold by itself. Nowadays, if you want to do it the old way, it won't sell. You really need to have the government getting involved and getting into the government-to-government deals to be able to open the door, then let the private sector sell.
In a way, it seems in retrospect that PNG LNG was very fortunate in its timing, because when the project was starting up, everyone was saying the window of opportunity would last until 2014, and that's exactly what seems to have happened. How do you read the prospects at this point in time, where gas prices have fallen also like 50%?
Yes, I mean, I think that you know, gas prices, contract prices have fallen because oil prices have fallen, but next year, this time, I expect the spot prices to be 50% lower than they are today. So I expect the spot prices for LNG to be $4, maximum $5 next year. So the environment facing LNG is a tougher environment than facing oil. But it is a matter of time. You know, by 2020, I expect the oil prices to be $70, $80. And the spot prices of LNG to become closer to the contract prices. So the key is that if you want to develop LNG, you cannot develop it today. You need to make sure that it comes in at the tail end of this period of time, so that the prices are improved and the market is more friendly. So doing a quick FID is not possible. A later FID is yes, making sure the project come in there somewhere in the range of 2022 to 2025 would sell much easier than if you want to bring it before 2020, which is almost impossible to sell today.
That kind of begs the scenario you draw for next year, begs a question of strategy for PNG LNG project, because as you know, they've been producing well above their nameplate capacity and selling the excess production into the spot market. Next year, if the prices fall, as you say, by another 50%, would that be a wise thing to continue doing?
Well, I think that ExxonMobil, as a marketer, will try to seek short-term and medium-term contracts. I don't think they would sell a lot in the spot market if the prices go down. You get yourself into 1 year, 2 year, 3 year contracts, and you get better prices. But it's a tough environment. Nobody can escape this environment. And the big issue in front of us is that would we have to have a train 3 for PNG LNG, or would we get Pyongyang into expansion of the existing trains? Of course, a new train for PNG LNG would be much cheaper than the previous trains because of the infrastructure. But at the same time, the view from the operator is that I don't have enough gas as yet proven. So the preference is to debottleneck existing projects. But whichever way you want to go, that has advantages that nobody else has. If you want to do a new project, you are facing bigger challenges because it's a totally greenfield activity. However, I think PNG, LNG, whether it's from the existing project or new project, can work. It still can work because of cost advantages, but requires extensive government involvement.
After the break on Resource PNG, we have a discussion with Mr. Wapu Sonk, Managing Director of Kumul Petroleum Holdings Limited. Welcome back to Resource PNG. Kumul Petroleum Holdings Limited has officially begun business. Now, its Managing Director, Mr. Wapu Sonk, took time out from his busy schedule to speak with Resource PNG soon after his presentation at the 2015 Mining and Petroleum Conference. We're privileged to have with us the Managing Director of Kumul Petroleum, Mr. Wapu Sonk. Mr. Sonk, thank you so much for taking time to join us on Resource PNG. First of all, the state of the transition towards Kumul Petroleum from the former NPCP. Where are we now?
National Petroleum Company of Papua New Guinea was established in 2008-9 thereabouts as a Croton number 2 entity. It was a self-company. It became National Petroleum Company of Papua New Guinea in 2010, and now since June 2015 it's now Kumul Petroleum. Kumul Petroleum Act was passed in June by Parliament. So we are now in a transition from National Petroleum Company to Kumul Petroleum.
It is exciting times as the LNG project is now into full swing, the one headed by ExxonMobil, and Kumul Petroleum plays a significant role in that as well, with the state's equity in the project.
Yeah, we are very fortunate that we've been able to export 145 cargoes. The plant is operating very well, and ExxonMobil doing a good job. We are the third largest partner in it. Unfortunately, the oil price is not at the level that we would have expected, but nevertheless, everything is going very well.
In your presentation, you mentioned something about Kumul Petroleum being more business-minded, bringing greater returns for its shareholders, the state. Can you just explain the thought behind that?
Usually all the SOEs, because the government owns the businesses, there's a tendency not to compete, not to be very commercially minded. So we've set out a strategic plan and a vision to be commercially competitive, and that's also driven from the fact that we have to deal with the oil searches and ExxonMobils and the Totals, and these are 100-year companies. They are very strong on the balance sheet. They are very strong technically. So to be able to be working closely with them and go into commercial negotiations and commercial discussions with them, you have to be at that level or close to it, so we can extract value for our people. That's why we have to be developing Kumul Petroleum with that kind of mindset. If we don't, then we won't extract the value that we should be extracting for our people, who are our shareholders.
Right now, despite the low commodity prices, it is an exciting time for PNG. We have a lot of investors trying to come into PNG. That must present a good opportunity for Kumul Petroleum as well.
It is, because I've traveled around, and PNG is the only area or country that is attracting investment still, even in this low commodity price environment, mainly because we have a low cost structure. We are able to deliver project on time and on schedule. That was demonstrated by ExxonMobil. So that has set the scene for future projects. So compared to the Australian projects and other parts of the world, our cost structure is low because we got cheap labor, and our fiscal regime is very attractive. So that makes it very attractive for ExxonMobil, Total, all the other oil and gas companies especially, to continue to invest. And PNG is still the priority area, and they've put on hold some of the other parts of the world, projects around the world, but PNG still remains attractive, and they still want to pursue. So we are fortunate in that sense, and we are partner in that development.
Revenue-wise, 2015 has not been that good. What can we look forward to in 2016?
I think 2016 is probably about the same. $50 per barrel oil price environment. 2017 slowly goes up to 55, 60, and 2018 gets a little bit better, 65, 70 barrels. So it gets better, but 2015 and 16 will probably be remaining about the same levels.
And for Kumul Petroleum itself, what will be your main focus in the coming year, 2016?
Our main focus is really upstream, Train 3 expansion with ExxonMobil, and Total project, the Papua LNG project. And then ourselves, we're looking at power projects, and we're looking at petrochem and training facility that we're building, so we can upskill our Papua Indians to actually go and work in those projects that are getting developed by Total and ExxonMobil and everybody else. So we're playing that role to have a fair share in the national content, especially in the jobs market.
On that note, Mr. Sonk, thank you so much.
Thank you.
And that ends this episode of Resource PNG. If you'd like to contribute to the program, get in touch with us via email on resourcepng@mtv.com.pg. To view this edition again, log on to www.mtv.com.pg, where you can find a link to the Resource PNG page. We're also on Facebook. Just search for Resource PNG. Now, until the next time, have a Merry Christmas. I'm Mary Botulo, and this has been Resource PNG.